All right, well, let's go ahead and get officially started. Greetings, everybody. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. I'm joined here by my friends Ken Kavula. Cy Lynch may be joining us in a few minutes. He's currently traveling. And Hugh McManus is checking in from, I believe he's in California these days. And we want to basically welcome all of you to the January session of the Roundtable. This is something that we've been doing now for about 2.5 years. And the intent is really quite simple. We want to share some ideas, and we really are serious about trying to identify 4 pretty good stocks to study here tonight. We're going to take a look at our track record here in a few minutes. I did kind of like that cover slide image of the night. I prefer to think of that as going out at dawn, not dusk, and a pretty interesting little picture that we ran into. Again, if you have any questions, if you're bashful and you want to do any follow-up Q&A to tonight, Ken's email is there on the screen along with my email. You just go to manifestinvesting.com. Likewise, even if you're not a Manifest Investing subscriber, we do post the play-by-play, the PowerPoint, and the archived recording of this in our forum. But if you would like anything after the session, write to either one of us. We'd be happy to get back to you on what you need. Let's get the housekeeping out of the way first. This is all about education and demonstration. We're going to pick stocks that we are serious about, that we think are worthy of study, but the rest is up to you. You have to do your homework. This is an educational demonstration, and no investment recommendation whatsoever is intended. We may talk about stocks that we actually own. Hugh McManus is stubborn. He keeps coming back to the same stocks, and I'm pretty sure he owns a bunch of them, so he'll be happy to share some of those with you later. Here's our agenda, just to kind of quickly go over it. We're going to take a look at our scoreboard, take a look at a little bit about where we've been. We do have a couple of stocks we want to talk about from the challenge perspective. That's kind of shorthand for selling consideration or selling decision making. Then we'll launch into our 4 selections. I'm going to cover Body Central. He's going to cover Microsoft. Cy Lynch is going to do another repeat on Landauer. And Ken Kabul is going to bring a new one for him, AeroVironment, I guess is it. And then we will do an audience selection, a poll of where you get to choose among those 4 options. And if we do have a little bit of time, we will keep the floor open for Q&A if we leave a little bit of time. But we will perhaps talk about one thing towards the end. I'll kick us off a little bit with talking about what we're doing here. And it really is, we mean it when we say demonstration. We're here to share ideas, but we're also here to try to put together a string of ideas known as a tracking portfolio that actually does manage to outperform the stock market. And we're specific about what we're aiming at. We're trying to outperform the stock market over the long term by 5 percentage points. It's 5% per annum. And we gauge that versus the Wilshire 5000. And we basically compare any stock that we talk about during any given month versus a mirroring investment in the Wilshire 5000. We also want to see that we pick more that go up than go down. We want to achieve that actual alpha or relative return target, but we'd also like to see 60 to 70% of the ideas that we share here at the Roundtable actually outperform the market over time. And it's here that we can start with a little bit of cyber applause. Because what you're looking at here is the Roundtable scorecard now going back, or the scoreboard going back 2.5 years. And as many of you know, we had kind of a rocky start. I personally have made a couple selections which have put a dent in the portfolio and kind of held us back a little bit, but I seem to be still alive and recovering and live to fight another day. But you can see that we had kind of a rough spot here, 1 to 1.5 years in. And again, the same thing we tell any relative newcomer or beginning investor or investment club: don't pay too much attention to that kind of stuff in the early years of the club. Give it some time. Basically focus in on identifying high quality companies and buy them when they're on sale. That's all we should be doing. That's what we're trying to do here at the club, or at the Roundtable. And you can see that we have reached a performance level of about 2% positive. Basically an alpha of positive 2 percentage points. Again, that's annualized per year, and that's what it all adds up to. I will tell you that 3 of the 4 nights here, the regular nights, Ken, Hugh, and Cy have positive relative returns, and I don't. So I'm kind of hoping to catch up to the other guys. But taken in collective, and when I mean collective, this number right here is the combination of our guest damsels, our guest knights, and the audience. And the audience has made several selections, and they're actually among the leaders. Their relative return is plus 5%, which, by the way, is our objective overall. That's what this line is here. The line down below here is what we refer to as the Dalbar line, or the average investor line. That's the performance level achieved by average investors. And again, the Dalbar study that we reference talks about returns experienced by average investors between 1992 and 2012, and that actual number is minus 5.3% per year. And obviously we want to do better than that. We're really pleased that our accuracy is now up nearly to 60%, that you can see there. So all in all, really nice trends, really nice tendencies. And I think, you know, one of the things that kind of grabs me is going back about a year ago when Ken and I both said we're going to stop messing around quite so much and really try to stick to higher quality companies and you know, less speculation, less turnaround type stuff, and it's worked out extremely well for both of us, but even more extremely well for him. Any questions or comments on that so far, Ken?
Well, I'm just happy that we've pushed ourselves into positive territory, and we just have to grab a hold of that one guy at the bottom end here and yank him up with us, and we'll be all set, you know?
So, sometimes you got to carry the dead weight. You just do, you know? I appreciate it.
It's time to either shut up or talk an awful lot, because at some point in the next couple of years, I would imagine that I won't be sitting near the top. I'll be sitting at the other end of it. So,
well, people do tend to take turns in this sort of thing. I will make sure everybody understands I am only about 0.5% down right now. So whoa, we're all coming around pretty good. Let's take just a moment to give a nod to the portfolio itself. Again, this is the tracking portfolio that's available at Manifest Investing. In fact, it's available on the internet without any affiliation with Manifest because it's a public dashboard. So you can actually use this link to look at this at any time. And what you see here is it's ranked from the largest influence, and these are the top positions in terms of, we might have to mute Hugh if he's, is that Hugh?
Yeah, I way too good of a microphone. I'm just stunned at Walgreen, actually.
Yeah, since you've picked it many times, huh?
Yeah, I'm not nervous about it.
Well, it certainly has done well. And again, let's decode this for the audience a little bit. Again, this is one of our dashboards. These are the largest positions in the portfolio. We've been downright stubborn about companies like BioReference Labs. I think Cy Lynch has picked that about 4 times himself. Hugh has picked Staples, well, now 5 times. And again, how you decode this is every month we take the companies that we describe here and the one perhaps that the audience votes for, and we invest $1,000 into that every time we do that. So in the case of Walgreen up here at the top of the chart, we've actually selected Walgreen 7 times. So $7,000 has been invested to generate this almost $9,000. So he was pretty thrilled about where that has ended up. And
yeah, and Staples is 7 times as well. So it's still languishing, yeah, but it's doing better than it was when we were buying it.
Oh yeah, it's doing great. Cisco Systems has done okay. A lot of companies down here. How about Southwest Airlines? Hugh and I picked that one each. That's a 2-time selection. Just a lot of good companies on there. Many of you have scratched your heads over Hugh's selections of Bank of America. You can see that it's been selected 4 times up here, going back over some period of time, and you can see that it's actually up to, again, almost $5,000. It's one of the top performing stocks in the stock market for 2012. So, interesting stuff. Again, very pleased with the performance, pretty much top to bottom. I thought this slide was kind of interesting. This is a group of stocks that have been selected just once. So $1,000 invested into these. And you can see they range all the way from Costco, that's pushing up on almost doubling. Again, that's only in 2.5 years. MWI Veterinary Supply, that's one of Ken's favorites. I know that's in a couple of his personal and family investment clubs. That, I believe, has nearly doubled in about 6 months.
Mm-hmm.
So a lot of pretty good investments. Kim Butcher's here tonight. This is one of hers. Deer, kind of a little bit different selection at the time it was made, but that one is up over 50% since she selected it. And we'll probably talk about this one here tonight, Synaptics, here in a minute. More than probably, we are going to talk about it. Synaptics, by the way, is up 60 or 70% in the last few months to get to that point. Herb Lemkool's pick of LKQ is here. Another one of our guest nights. I think Rue 21, another guest night selection by Nick Strategos. So again, these are one-time selections that have done pretty well, so we'll call them one-hit wonders for now. One selection spectaculars, whatever we want to call it. All right, so let's go ahead and get into the business part of the discussion here. As many of you know, what we do with our dashboards at Manifest Investing is we will rank them from highest to lowest return forecast. That's what you see over here in the far right-hand column. And even for any portfolio, the ones at the bottom, when you rank them from highest return forecast to lowest return forecast, again, that's projected annual return, the ones at the bottom are the ones that are kind of on the hot seat. Now, I threw research in motion back in there just for conversational purposes. We actually have taken that out of the portfolio, but I wanted to make a point and propose a rule change. We'll get to that in a minute.
Is the rule change when it goes to your benefit after we close it out, you can count it? Is that?
Well, yeah, because we got to do this because I think we need to adopt the UN Security Council type approach. It has to be unanimous. Because I voted no last month, and we're going to take a closer look at that one. But okay, but Synaptics, and welcome, Mr. Lynch, by the way.
Thank you.
You notice he snuck in there to assault me.
That's correct. I heard that you were. I noticed you trying to slip rim back in, so I had to show up.
All right. Well, let's talk about that one again. And Ken, maybe you can wrap some thoughts around how, even if this were a portfolio, we wouldn't consider it urgent, I guess would be the way I would put it, because of the overall return forecast for the portfolio. You could share a few thoughts about that?
My investment club just met this evening, and to be honest, the numbers at the bottom of our columns for my club are very similar to the numbers at the bottom of these columns for this particular portfolio. We had a par of about 14.5. We had a quality of about 80. We had EPS stability and financial strength in the low 80s, and we had growth of 10.9% sales growth for the portfolio. So we didn't worry too much about any of the stocks, even the ones near the bottom of the list, because all the numbers in the total portfolio were pretty well balanced. Now, this is a little bit different strategy on these things, and I would not be opposed to freezing the gain that we've made in Synaptics right now, or for that matter, freezing the gain that we've made in LKQ. Both of them have been good performers, and with virtually no potential left, I have no problems in freezing out the gains we've made.
Yeah, and perhaps we can visit LKQ next month. Let's go ahead and talk about these two that we've got. And again, we're focusing in on the ones at the bottom. And again, I just want to make a point. You know, RIM, we basically exited the position somewhere in this range at the December meeting last month. And again, this is not a traditional investment. It was a clear falling knife. It was a speculation, and the type of investment that you really don't pay as much attention to the fundamental analysis stuff. And that's the point that I actually went over last month. And you know, I would urge anytime you're in one of these speculations, and I'm not going to spend a lot of time on this other than to point out I was uncomfortable with selling it here because I wanted to wait for the next one of these. And we actually had that in the last few days. This stock actually went up 50% this month. And again, you're basically, you know, timing your exit on different criteria. So again, my appeal to the members of the roundtable is that I think selling decisions going forward should be unanimous, a true United Nations Security Council type situation.
Unanimous of the nights that are there that evening, Mark?
Yes.
I can buy that, Mark.
Yeah, and I just think, because again, I respect you guys, and if you look at this thing from a fundamental, we're getting some pretty good noise there from Hugh. Are you hearing that?
Yes. I'm hearing something.
What did you hear? Because I'm muted from this microphone. I'm mute electronically on the.
Okay, I'm hearing a little bit of racket. No problem. Anyhow, from a fundamental standpoint, this thing is a train wreck. From a trading or a non-core perspective, a little bit different story, and again, quite a spectacular move in this company here recently. So with that, let's get back to more fundamental type stuff.
Well, Mark, we're getting a good question from Jim, and he'd like to know, looking at what you're looking at right there before you moved away from that technical screen, would you hold RIM today?
If I was actually holding RIM, I would have sold it. I basically would have done an algorithm type approach. I would have sold it a couple of days ago. When it hit this point up here, and it went to a relative strength greater than 70 and actually closed slightly lower, the relative strength index actually closed a little bit lower, I would have basically algorithmed out somewhere in that $17 to $18 range. And that's just a completely different way of skinning the cat, but that's exactly what would have been done.
Yeah, my instinct always would be never sell after a big drop,
Yeah, and that's
unless the SEC has padlocked the headquarters of the company or something.
Right, and if I failed to execute this one here that we see right here, we actually had a drop here in the last couple of days. So again, we're in the situation of if I was actually holding it and speculating, I would hang on and wait for the next time it got up above 70.
Yeah.
Unless something really goes wrong.
The only thing, and again, we don't need to beat this to death, and I understand the point that you're making, Mark, and I can't say, looking in particular, of course, I can't argue with history, but I too have played the speculation and falling knife game and have ended up selling near zero.
Yeah, absolutely.
And to be honest, probably had, although I can't recall your strong RIM argument on fundamentals safety. I think maybe no debt and a lot of cash or something. I can't recall.
That was part of it.
But you have mentioned there is some measure of safety that RIM's not going away, but there's a lot of argument that maybe RIM is in serious threat. And I mean, Washington Mutual is the most recent personal debacle that comes to my mind. That I was falling knife and I was saying how low can it go, and I was doing some fundamental analysis that even convinced me the dividend was safe, and they cut the dividend about a month later.
Right.
And the stock kept going down. So I mean, in that I was not purchasing as a fundamental long-term holding. I was speculating.
Right.
So,
and
lost. So.
We'll make sure that we get the archive recording up. You can actually go back and listen to my argument. I mean, I voted no. I mean, I'm serious. I mean, it's just not.
When was this? This must have been November, was it?
No, it was last month.
Wow. I was there last month, right?
I think it was November because I think I voted with.
I'll go back and look, and I'll make a note about it.
I think you did this behind my back.
Well, I needed your support, Hugh. Okay.
Because I know you de-lilied the portfolio too.
Well, yeah, we nailed you when you weren't here one time.
Yeah, well, that's the way to do it.
All right. Let's talk about tonight's challenge.
Mark, just a comment from Ann, one of our damsels, and she says, just face it, guys, Mark doesn't want to give RIM up, okay?
Well, I do now. 50% later. Oh, okay, let's go ahead and talk about this one. Ken, you want to kind of give us an outlook on this one and where your thinking is these days? Hello, Ken?
I'm here. This is a really good stock idea that I talked about an awful lot and that I liked an awful lot, and I never put real money into it. And therefore, Mark, I haven't followed this very carefully the last maybe year, year and a half. This is a fairly old idea of mine, maybe as much as 2 years old. I do know some friends that put real money into it, and they were fairly happy with it, but with the value line total return going forward at 4%, and with the line starting to really flatten out here, I'm wondering, you know, whether or not we shouldn't take this sudden surge in the stock and be real happy with the gain and move on.
Yeah, the stock price has gone up considerably in the last couple of months, and it actually is in the realm of, again, once again, Ken's got a positive alpha for one of his picks. But I don't know, I kind of look at the analyst estimates out here for the next year or two, and they're not in the strongest position, and I guess I would urge our UN Security Council to consider the prices really do follow earnings trends, and that maybe we just basically assume a successful position and move on. So does anybody want to rise in dissent?
Well, I will.
Are you guys okay?
I tend to rise in concurrence just because, and you don't have a price bar that I mean, I see a price bar, but I don't see a current price, so you can't see it. But I'll tell you what makes me,
yesterday's price size 36.
Yeah, no, I was trying to see what the price. I assume that's a 52-week high or something along those lines.
Probably pretty close.
Yeah. Because but the way Ken was talking about a price run up, and of course it would look to me like that's probably a big part of the low par and the low total return on value line. But what you were just pointing out, the projections, it always makes me nervous to see a stock where where sales are either going down or flat, earnings are going down, and the price is going up. I tend to say that sounds like a trader's dream. Let's sell it and keep our gain, because as you said, doesn't long-term price follow earnings? So I mean, it sounds like somebody's betting on a come of some sort.
Yeah,
and it may be a long-term bet, but something tells me that's something there, but you know, something tells me something's going on supply and demand side that isn't making a whole lot of sense.
Right.
Either the market, somebody knows something nobody else knows, or else you know, somebody's betting on something. You know, I mean, a takeout, you know, buyout. Those sorts of things can be what's going on in those situations.
And Hugh, I assume you're in agreement. By the way, those blue dots are earnings. I know you don't often see those on some of the companies that you follow, but I'm kidding.
Yeah, it's so last century.
Let's go ahead and exit this position then. And this month we have unanimous agreement, if I'm correct.
Yes, it sounds like it.
All right. Any questions before we head into the stock presentation portion of the meeting, Ken, or anything up on the board?
No, we're staying pretty current on questions that are relevant.
And by the way, for what it's worth, you technicians out there, if you pull up Synaptics, there's one heck of a resistance level. We're coming up against that now. We might take a look at that in the after session if we get a little bit of extra time. All right, I'm going to go ahead and kick these off. We basically randomized the order, but I have the leadoff position this month, and I want to talk about a company I'd never heard of before the last couple of days. The name of the company is Body Central, ticker symbol BODY. Just wanted to give a plug for the blog there. If you're not familiar with our blog, check out expectingalpha.com, and we talk about this kind of stuff all the time. You'll be hearing more and more about that as days go forward. But you can see here with Body Central, we're talking about a company that has not been around that long. We're operating off of a couple years of estimates, at least for 2013 here. And you can see that we haven't even though the company's actually been around since the early 1970s, I believe, it hasn't been publicly traded through a recession that you see here, this gray shaded area. So that's just something to keep in mind. Obviously, this is the type of company. It is a retailer. It's a specialty retailer that caters to the 18 to 35 female demographic, although they're trying to branch out into a little bit broader demographic. But and I actually think that I may be getting myself in a little bit of trouble with lipstick on the collar there, but we'll go ahead and roll the dice here a little bit. But all in all, pretty decent looking longer-term growth trend. Where did it come from? And again, you can ask for a copy of either this slide or the entire set of slides by using the email addresses on the cover slide. But it actually comes up in a screen where I'm looking for a combination of both fundamentally strong factors, and that's exhibited here by this strong 20% return forecast in combination with an excellent quality rating. So it actually ranks among the top companies based on those two characteristics. And you can combine that with a relative strength index that's basically suggesting a potentially oversold situation right now, down at $8, and some pretty good characteristics. You can see that the value line, low total return forecast, is it's in the nosebleed area. So it's this is a little bit of a roll of the dice. This could be a value trap, without question. But you can see from top to bottom there's some excellent ideas. In fact, Ken is going to be talking about one of these right here. A number of our recent favorites are up here. The remote control company right there. Qualcomm is a decent study right now. But some very, very interesting companies bubble to the top of our screens. Basically what I'm looking for is the next Chico's. Those of you that have been around this community for a while will remember with great fondness what happened with Chico's back in the early first half of the last decade. And Chico's is a company that was held by many individual investors and investment clubs, basically going from $2 to just short of $50 in a period of 4 or 5 years, and brought smiles to many of our faces. So we like that. Here's one of those key characteristics when you're dealing with one of these type of companies: no debt. No debt for Chico's even to this day. So even if we don't go back and catch that original Chico's, by the way, this time frame back in here, you're talking about a company about the size of Body Central. There's another company out there, and it comes out of the Houston area, so maybe we'll assign this to Ann for some quick personal research. Francesca's might also fit this same mold. Francesca's actually looks pretty good too. I believe the ticker symbol is FRAN. But what we're, even if we don't catch this one, maybe we catch one of these periods here. You can see the Chronicle here superimposed for Chico's, and a nice price point here that aligns with that low price point. So that type of thing is even possible after a bit of an episode in the stock. And we know that the Body Central is actually having one of those episodes right now. You can see here a quick look at the value line investment survey. Elevated low total return forecast. Again, no debt, key characteristic for companies like this. Quite a price swoon. This company has gone through some massive turbulence. They've had a change in management. Hopefully it's a change in management for the good, but they've actually taken quite a dive. They've gone from a price just above 30 to the current price, which is currently in that $8 range. It's in the current update for value line if you want to grab it. You can see that the numbers that we have for profit margin have been in that 5-6% range, and that value line has a long-term expectation in their 3 to 5 year forecast of 6.4%. And then for a retailer, again, in a growing retailer, very important to see steady growth post-recession in the number of stores out there. All these things are important when looking at a retailer like this. Specifically, this one gets me kind of giddy. This is one I'm going to look at closely. I do not hold shares of this one, but I'm going to look at it a little bit closer, even though some people think it's a value trap, because I don't see any stores in New England or New York or New Jersey, and there's not a lot out here. That's probably in Phoenix, but what about California? What about the Northwest? Again, potential for geographic expansion. Pretty strong. Minnesota. They need closing coats up in Minnesota. Good stuff. Here's a look at the technical chart showing the drop down and this horrible thing back when they had the change in management, a couple bad quarters, but you can see that they've dropped down into this range where you could argue that there might even be a little bit of support down there, and again, potentially oversold based on the relative strength index. Here's a quick look at the equity analysis guide that you can go through and crank in your own estimates. Again, this is a relatively small company. I'm comfortable, especially looking at that store growth profile, using a forward-looking growth forecast in the 13% range. I'm not going to go anywhere near that 6% number we saw from Value Line. I'm stopping at 4%. So a 4% net margin, which is something that they have done. There's no guarantees that they'll do that. They might slip below that. You know, Coldwater Creek is certainly seeing incredible challenges these days. Relatively reasonable PE for a company like this. And again, you get to a point where you verify and confirm that it's not absolute science fiction to have a projected annual return somewhere in the upper teens to the 20% range. And one other thing I do like to point out, one of the best small company stock pickers in the world is Jeff Carden at Wasatch Advisors, and he just picked up between 5 and 6% of outstanding shares. So you're in pretty good company. Again, there's other people out there telling the other side of this story that this is a management nightmare, train wreck, falling apart type situation that is not worth pursuing. And then I'll leave you with one last provocative slide, because I know most of the men in the room here tonight need to be reminded that Valentine's Day is coming. And that just says Valentine's Day to me. So my selection for tonight is Body Central, and hopefully it'll propel my overall relative return in the right direction. Any questions or comments? You guys are speechless. We'll go ahead and move on to a repeat selection from Mr. McManus. Go ahead and take us away on the Microsoft tour.
And you can hear me all right, I hope.
Yes, you're fine.
Good. Yeah, Ernie was urging me last week to have a look at Bioreference Labs. So I was kind of interested in it when he said it. Then I discovered it was close to its 52-week high, and I learned lessons way back in the early 90s about buying companies at the 52-week high, so I'd avoid doing that. And went back to some of the companies I own and have looked at it many times in the past, and two of them are Microsoft and its partner, Intel, which are currently trading relatively close to their 52-week lows, but the companies both look pretty good. But I jumped all over Microsoft pretty much because of its upcoming product releases. The Surface, the new tablet that it has released, sales of which are looking pretty good and looking pretty promising for the future, and also the release of Windows 8, which perversely means that the last version of Windows sales will start to pick up. The company has been in the doldrums a little bit recently because spend on IT software and to some extent infrastructure slowed down really dramatically during the Great Recession and really hasn't started to recover fully since. And that spending or reduction, that kind of spending in the business community impacts not only companies like Microsoft but also Intel and another one of my staples, Staples. But Staples stock share price has been doing reasonably well recently, whereas Microsoft has been approaching its 52-week low. And I've been buying it, I have to say, pretty regularly for the last number of weeks. In this presentation, rather than extract things from analyst reports or the Microsoft website, I just wanted to go ahead and just show you the kinds of things that I look at when I'm picking these kinds of companies. There's umpteen dozen sources of information, but this just shows how the company has been doing, say, relative to the S&P. It's underperforming. And perversely, I kind of like that kind of thing because I buy companies for at least 5, 10, 15 years. So even the time horizons that are looked at on Yahoo or some other sites really don't do justice to what a company may or may not do in the future. But it hasn't been performing well recently, and frankly, if you look at the stock price for the last, I'd say, 10 years, if I recall correctly, Microsoft first started paying a dividend in March 2003, so almost 10 years ago. And the share price has languished ever since. It's gone into the low 20s. I think at one point it hit 35. But it really hasn't performed the way we remember it fondly in the 90s, when the company really was king of the hill, just a behemoth in its space, wiping out all before it, dominating the software space. It's done pretty well with server software, but not as dramatically as it did with PC software. But it's moving along relatively nicely, and it has some nice products. Surface tablet, I don't own it, I may buy it, but people who do own it really, really like it. So we skip on to the next slide. You can see that the financials of the company look really good. I mean, it has very, very strong financials. Most recently, its sales or earnings numbers haven't been that good, and that might explain in part why the stock price has been whacked a little bit recently. But most analysts do not seem worried about it, and they're looking at it, surprisingly, for the long run. The long run for them is a year and a half, or even shorter, but they believe that things will pick up revenue-wise for the company. But it has a very phenomenal operating and operating profit margin. It's flush with cash. You can see 63 billion there sitting on its balance sheet, 68 rather. Be nice if it gave a lot more of that to its shareholders. Gave a nice little bump to its dividend last year. But its revenues are only 73 billion only. But it just shows you the proportion of cash on the balance sheet compared to revenues is really quite high. And it has $8 in cash per share. That's quite a big ratio. It has very little debt, but its debt actually at this point is slightly higher than the industry average for a software company. There was times when it had absolutely none, but still its debt to equity looks manageable, as does its current ratio, which looks fine, and the book value per share, which, not surprisingly, is built up mostly with cash. So we skip on to the next slide. You can see that its most recent revenue number, which I echoed in the last page, is about 73 billion. That's the
Hugh, we've seemed to lost you.
Am I still here, Ken?
You're still here, Mark.
Okay, we lost Hugh for a minute, maybe.
When did you lose me?
About 15 seconds.
Just as you were starting to talk about revenue per share, Hugh.
Okay. So you can hear me. The revenue per share is 8.7 billion, but the point of concern, if you scroll down to the bottom, and this may be the explanation for why the share price has not done well recently, is its quarterly earnings growth year over year has declined. And part of that, some analysts will tell you, is due to the fact that spending has slowed because people know that the new version of Windows is imminent. So the software sales have dropped. The company has also had some write-downs on the hardware side of things. I think there are justifiable reasons for why you see a slowdown in the bottom line. But looking forward, there seems to be a general consensus that this will be a temporary event. And here is a look at the SSG. It looks really messy. I kind of like this if I think a company has the opportunity to grow sales in a nice steady basis, as Microsoft appears to have over time. And I believe that is going to continue to happen in the future. A temporary glitch in earnings, pre-tax profit, may represent a buying opportunity. But I think this part of the SSG tells the story as to why we've seen a slowdown of late. And on the next page, I'll just show you, I believe, the assumptions that I made in the SSG. I'm assuming revenue growth of 9%. We'll look at that a little bit later. I'm assuming also that things like the tax rate, general expenses, the shares outstanding, really reflect the default, or very close to default settings in the current version of the SSG. And it gives an implied EPS growth rate year over year of 12.9%, close to 13 for the next 5 years. A little bit higher than some people are saying, as we'll see in a jiffy, but maybe not out of the question. So skipping on to the next slide, you can see Value Line has recently raised safety but lowered timeliness for this stock, and I think that happened in the middle of last year, around July. So we'll see what the next few editions of Value Line have to say about Microsoft. But overall, when you read the commentary on the Value Line report, which, by the way, because Microsoft is a Dow component, if you go on valueline.com, you can download the Value Line report for free, as you can for the other 29 components. But they're pretty happy about this company, even if they haven't given it a 1 for timeliness. Just moving on to the next slide, when you look at the annual rates and the current position. The current position is just to give more ammunition to the idea that it has a very strong balance sheet and it's doing well income-wise, revenue-wise. But when you look at the projections for 2015 and beyond that value line analysts at least give you, they have a much more optimistic growth rate for revenues than I had, and a slightly lower growth rate for earnings, 11% for each. And of course, they believe that the pace in the increase in dividends, and Microsoft, as I said, has paid a dividend for 10 years now, but that will actually outpace both revenue and earnings growth. And that's not a concern. As we said earlier, it has a lot of cash on its balance sheet. And this is what analysts are saying recently. And again, if you look at what they're projecting into the future for the next 5 years, their earnings growth rate of about 8.3% is slower than the number I was talking about, and certainly slower than the industry average. The thing I've tried to find out if this industry average is weighted. I'm still looking into that, because if it is, I can't imagine that Microsoft's growth rate will be that slow. So we skip along to slide 28. We abstracted information here from the Manifest site. The projected annual return for Manifest is 21.3%. I like that. It's much higher than the average and much higher than the kind of thing we want. And the sales growth forecast is 9.4. And I've chosen 9 in my SSG. I think this number is pretty good, and I would be reasonably confident about it. And the projected annual return from the stock selection guide is actually 17.8%. So it's in the 21% range, high teens, low 20s. And then moving along one more, I think we can look at the consolidation of information from different sources. You see Value Line has both earnings and revenues and earnings growing at 11%. The SSG, I had earnings growing dramatically at 13%, but the top line a little bit lower. And Manifest has a revenue growth rate of 9.4%. In fact, my SSG number is 9.0 if I remember correctly. I typed this in incorrectly. So if we can skip along to the next slide, which I've just shown you here, section 4 of the SSG, where it looks at risk and reward. It has a relatively high upside-down ratio, my analysis of 5.3, but I thought I was reasonably conservative with the PE ratios. I didn't select a high that was close to or higher than what has happened in the last 5 years or so. And with low, I actually avoided the low PE ratio because we had some singular events recently that, fingers crossed, are not likely to repeat themselves. Of course, if they do, there's a nice buying opportunity. So it certainly looks from all accounts to be a buy. So it has a little bit of a spot of bother right now. It's not a long-term thing. It's not a problematic thing, but the stock price seems to reflect that issue. I think sales are down in anticipation, or were down in anticipation of the launch of Windows 8, but they weren't down as much as people expected. It still is having issues in its online division and certainly in its hardware division, but sales of Microsoft Surface, its new tablet, are looking good, and they look as if they might increase. And it certainly looks as if this Surface, this tablet, because it's integrated with the Windows package, can offer more than, say, the iPad. And actually, its mobile phone division or mobile phone offering is doing quite well too, mostly due to licensing deals, but another area of potential growth. So I think the growth rates support an optimistic view of Microsoft 5 to 10 years into the future. So hence my reason for selecting this company.
So another repeat selection. And by the way, Hugh, I think they came out with Office 2013 today.
Oh, okay.
So I think that's out there.
I was actually hoping to be able to buy Amazon because it had a bit of a whack over Christmas. Its revenue, its expenses grew, but of course the stock price went up in after hours trading.
Yeah,
it's a company I want to own as well.
Went crazy
More
this afternoon, yeah.
Yeah.
All right, well, thanks, Hugh. Let's go ahead and move along to another repeat selection. It's one that Cy has talked about for a couple of months, Landauer.
All right, thank you, Mark. And Landauer, I'll be pretty short and sweet on because as
Cy, can you boost your volume, please?
Yeah, it might help if I pulled the microphone down in front of my mouth, wouldn't it?
That helps.
It was up over my forehead. so that you couldn't hear me drinking. Ginger ale, by the way. But in any event, as I was saying, thank you, Mark, and I'll be relatively short because, as you alluded, this actually is my third straight month picking Landauer. I wasn't able to make the December roundtable, so it goes back to October and November. But the stock has had a pretty decent price run-up since we have selected it, and has had a good return. Of course, credit also goes to Mark for picking it in early 2012. I think it's been picked by us 3 times and by the audience once, and I believe all of those picks are positive relative return picks. Very simply, what intrigues me about Landauer, I guess go ahead and show the next slide, which I think is my eagle, if I recall, right? Here's the eagle for Landauer with the options chosen. See the annual rate of sales growth is 8% that I projected. That's a little bit lower than Manifest is showing, which is around 9%. Based on the value line projections. The company's latest projection for 2013 was between 7.6 and 10.1, if I recall correctly. So I'm on the low end of that range, but both Manifest and value lines right in line as well. They've suffered a little bit of margin hit recently because of some computer upgrades and acquisition expenses because they've entered 2 divisions, the medical physics and the medical supply areas that I've talked at some length about in previous months, and I'll just refer you back to the October tape on that, although we'll very briefly see it in the next slide if you want details, or also the Landauer website. They have some presentations that will give you some information on those markets. But the margin should be able to recover. You can see the value line historical margin for the last 7 years or so, and realize that the company started its current management and reorganization toward the company that it's becoming now in the 2006-2007 timeframe. So those historical margins make some sense to take a look at. You can see I'm a little bit more aggressive on margin than value line is, but I'm comfortable given the history and where the company's going. The value line's probably a little pessimistic there, but then again, it's with which hand are you looking at? I'm a little more conservative on my sales growth. The bottom line being earnings, we come in about the same. Working on down PE. Forecast is again right in line with history, maybe a little bit higher, but again, this is a company that is accelerating its growth because it is entering some higher growth areas in the medical physics area and the medical supply area. Those of you who aren't familiar with Landauer, it is a radiation monitoring company, historically occupational radiation exposure, but they're going into the medical radiation exposure, the positive side, not as opposed to the negative. They've been looking at radiation as is not good. They're now moving into the positive uses of radiation in X-ray and MRIs and those sorts of things, as well as being diagnostic radiation, as well as treating radiation. Radiation therapy for cancer in particular. So I find the PE reasonable. All of that gives me a projected total return of 16%. As you see at the bottom of my eagle, the 2 things that intrigue me about this company, we'll see more of on the next slide, but don't jump there quite yet, Mark, is the potential for stronger growth going forward. I think that our bets on growth in the low single digits in the high single digits could prove to be low, and that would be a nice surprise as the company expands into the new areas. But notice that yield of 3.8% in this market for a company with the quality in the 80s that Landauer has, that's a tremendous yield coupled with the growth rate. That's what particularly attracts me to this company. Flip to the last slide,
Okay.
and we'll wrap it up.
Breaking up a little
Next
bit.
slide, Mark. There we go.
There you go.
This is just a summary. I'm sorry? Okay. This is just a quick summary of 2012, which ended in November, I believe, versus 2011. And the main thing I wanted to just point out here is notice in 2011 bar chart on the extreme left-hand side of this chart, you had the dark orange, the traditional Landauer, the lighter color, kind of a yellowish on top, which is the medical physics, that being the medical radiation that I referred to earlier. That was an acquisition. Notice that at 20 million grew into percent growth rate over the last year, and then they've X'd division or segment that they're looking at, the medical product segment, and they're expecting good growth there. So that's why I'm saying that if those segments continue to grow at higher rates than the radiation measurable Landauer, then I think we will see growth, which will lead potentially to higher PE ratios, as well as, of course, higher growth and a stock return over the long term. I've picked it for the third month in a row. Yield plus, I think, a little bit of potential for outsized and unexpected growth.
Fantastic. Well, thanks, Si. And travel safely.
Thank you.
Which brings us to our fourth and final selection for the evening. Ken, would you like to take us away with AeroVironment?
Sure would, Mark. Folks, when I start investing, I like to think about what might be something that people aren't even thinking too much about today, but maybe is going to have a pretty large presence 10 years from now, 5 years from now. Some of the very best investments that I've ever made were companies that were relatively undiscovered, as well as the kinds of things the company was doing, and they've made a lot of money for me. Some examples would be Cognizant Technology that I bought well before the word outsourcing was something that was common to a lot of folks. Electronic Arts that I bought after playing a very elementary computer game and deciding that this was something that could just hook millions and millions of adult males and keep them glued to their computer screens. Quality Systems, even though it's recently had some issues, was a great stock for me because it set the stage for electronic medical records. And this stock, AeroVironment, I think has some of the same kinds of characteristics. I'm not going to put a lot of numbers or a lot of words on the screen, but I'm going to ask you to sit back and think about the potential in the kinds of products that this company deals with. These are the people that make drones, but they don't just make drones for the military. They make all kinds of drones for all kinds of applications. Here we see a soldier setting a drone in motion that will be able to do some reconnaissance for the unit that the soldier's attached to. But notice the drone that has police written on it. This is a drone, relatively reasonable price when you compare it to a helicopter or a plane. But this drone can be used by police to view large areas, to follow movement, and to do a lot of the same things that currently police helicopters are doing. I see the picture on top here. We have another soldier showing that these drones can be flown or released from a moving vehicle. Here's a close-up of what one of the drones looks like, and AeroVironment makes 8 or 10 different models that are currently flying or in production. Some really cool names to some of these drones. You might want to take and check out the web page and look at some of the presentations on the page. But this little handheld unit up in the upper left-hand corner of this slide shows what the display from the drone looks like. And it's basically kind of a Garmin-esque kind of a screen where you can see exactly what's on the ground, including foliage, including roads, including buildings, but you can also see people, and you can see things happening. And these drones not only can do reconnaissance, but they can actually be put into attack mode if necessary. Now the company also has one other division, and it's about as disassociated from remote control airplanes as you possibly can get. But AeroVironment also makes charging stations for electronic vehicles. This slide in the middle right here with the white background, the window, shows what a charging station would look like hanging on your garage wall. If you had an electronic car, you can buy one right now on Amazon.com. You can buy a charging station. It's a slow charging station, which means that the charge would take as much as 10 or 12 hours to move into the car and to bring it up to full charge. But it just hangs on the wall of the garage, and when the car comes home, you can plug it in. Here's a brand new charging station, 2 pictures of some of these stations that AeroVironment is currently moving and creating this superstructure, this infrastructure throughout the entire country for electric cars. These happen to be high-speed charging machines where a car can get a new charge, a full charge, in as little as 30 minutes. You can have these fast charging stations all across the country. You can also have multi-port charging stations where a half dozen cars, when they're parked at work, can be plugged in, and they can get medium length charging attached to them. And AeroVironment also provides all of the installation services as well as a lot of the kinds of maintenance that these stations might require. And again, AeroVironment is teaming with a number of different companies trying to roll out these stations throughout the country, trying to create the infrastructure. We seem to focus a lot on this relative strength chart, so I'm showing that it doesn't have a particularly appealing technical chart to it right now. It's not with a relative strength above 70, which might signal a buy to, I'm sorry, a sell. But you know, there's a lot to be said for good, solid fundamental analysis. So that's what I'm going to stick to, and what I do stick to most of the time. The value line forward projections show a pretty decent low projection number of around 14%. And the annual rates going forward, you'll notice revenues at 14.5, earnings at 13.5. So certainly we're looking at a company that has decent growth going forward. Some of you would like to know where, in fact, did I find this company in the first place. So I'm going to just demonstrate that it's only a couple clicks away to come up with companies just like I'm showing you right now. I'm going to my favorite website, and I have it bookmarked, and it's right at the top of my bookmarks. It's Manifest Investing. And I'm going to do a stock search. And notice it's only one click, a quick click to get to the stock search. Tonight, the MyPower number, the average for the whole market, is about 7.2% potential return. 5 points above that is 12.2. So I'm going to ask for companies that will give me 12.2 or better return. I'm going to ask for high quality companies, that's 65 or above. I'm going to ask for decent balance sheets. I'll go 70 and above. And I'm going to ask for a little bit of earnings stability, so I'll ask for the 65th percentile and above on that. And I'll do a search. And you'll notice just about as fast as I can push buttons that 58 companies are spit back at me which meet those criteria that I set right there. I love to look right in the middle, right where the top of the sweet spot moves into this too good to be true area. And the 4 or 5 companies above this line right here and the 4 or 5 companies below this line are always very attractive to me. Here we go right here, AeroVironment sitting with a potential of about 19.1%. Let's look real quickly at my stock selection guide. This is for Synaptics, which I was looking at while Mark was talking about it. But here we go with AeroVironment. I'm looking at no debt of any kind for the company and a pretty consistent sales line, which I really do find intriguing. I noticed that there was some trouble during the recession. I do see a little bit of hit on earnings, but I do notice that the recovery since the recession has been pretty strong. I've decided on 14% growth going forward, and I noticed that margins have remained fairly consistent for the history of this company right here. Return on equity, a little bit less than I would consider healthy. I really would prefer return on equity to be somewhere near 15, 14, 16%, but it has remained even, and it is showing a recovery from the depths of the recession. I'm looking at a PE which is significantly below the average PE for the last 5 years. I did choose to strike the 23 at the low side during the recession as an outlier. I've chosen PEs of 25 and 15. That's an average PE of 20 going forward. I've adjusted for the most recent 4 quarters, and I'm getting a pretty healthy buy. I'm not going to quibble about this number right here. It's a little bit high, upside, downside, and I might fool around a little bit with these PEs if I were doing a very detailed study. But I find that this 18% right here is very close to the place where if I click on AeroVironment right here and take it to its manifest sheet, I find that I'm in the same ballpark with manifest investing. I chose a 20 PE going forward. Well, Mark has a 19 PE going forward. I think that I'm in pretty good shape with my PE and with Mark's judgments coming from the analyst community. So I'll present to you this company, AeroVironment, with an eye towards maybe discovering a company that will reward me handsomely because the products that it's dealing with have a huge amount of growth attached to them for the next maybe 10 or 12 years or longer.
Good stuff. Good industrial company. Probably fits pretty well in the tracking portfolio. And by the way, that does show up on our traditional screening results, and as I showed a few minutes ago, in the screening results for tonight.
Mark, I'm going to make you presenter again,
Okay.
and I'm ready to launch the poll to see what our attendees would choose from the presentations that we've made this evening.
Okay, and if you're new to the session here tonight, again, even if you're here for the first time, we welcome your voting participation. There is no truth to the rumor that people from Chicago get to vote as many times as they want. Ken will launch the poll, and please select your favorite from the 4. I will remind the audience that Valentine's Day is coming.
And the poll is open. You can use your mouse to click on one of the 4 choices that we've presented this evening, or you can click on none of the above, and if that would win then we would not make any investment from the audience this evening.
And
we
that's
have about 2/3 of you voting. We'll hold it open until maybe we get 80% of you voting. Just move your hand, move your mouse, and do a click on one of the circles. We've pushed ourselves up to 77% voting. Let's get 2 or 3 more of you to put a vote into the till here, if you would. And we've gone to 84%, so let's take a look at that poll. I'm going to close the poll, and I'm going to share the results of the poll. You'll see
it's a
that
landslide.
2/3 of the audience has chosen AeroVironment, 9% Microsoft, 12% Landauer, 11% Body Central, and 2% of the folks just don't like any of those 4 particular stocks. Well, so we'll add a second position to AeroVironment moving forward.
That just tells me our audience, you included, have a lot of, you think about Big Brother a lot.
AeroVironment is certainly not an up-and-coming company. The FAA just issued regulations late last year, pretty much opening the skies to these drones. It could be 10 to 20,000 of them buzzing around in the coming years.
You know, AeroVironment does 85% of its business in these drones, and that's the major product right now. But what intrigues me is this 15% of its business that it does in these electric charging stations. If we're really moving in that direction, we're going to need somebody to really quickly build out the infrastructure. And AeroVironment appears to be one of the very few companies that is in a position to capitalize on that right now.
Yeah, I think that's just shrewd. All right, I'm going to go ahead and close things up with just one quick, just one thing. Normally we'd go around the table, but we are a little bit over an hour. We do like to keep these to 75 minutes or less. But I ran into a fun fact just the other day that I thought I would share. It comes from the guy who wrote the book, A Random Walk Down Wall Street. And he basically went back and looked at 358 stock funds going back to 1970. And literally there's only 1/3 of them left from that time frame. And only 5 of that 119, actually 5 of that 358, had actually outperformed the stock market by greater than 2% over that time frame. And I think that's really, I don't know if it's troubling. Guys, feel free to chime in. When I sit here and I look at us, look, we've got 4 knights, a couple guest damsels, a couple guest knights, and the audience. And when I see 7 out of 9 of those participants, 7 out of 9 outperforming, again, unfair comparison, 40 years versus 2.5 years. But my experience in, watching the investment clubs in this area and working with individuals is that we do better than the market a whole lot more than 1.5% of the time. So as I say, welcome to Woebegone, apparently.
Mark, we're getting a couple questions about the posting of the former meetings. For example, is the December meeting tape posted right now?
Actually, I don't think it is. Kurt had that on his list for this week, so I think we'll get it up there within the next couple of days.
Okay, so Marie, maybe in a week, if you still don't see it, drop me an email or drop Mark an email, and we'll give Kurt a little bit of a nudge and make sure he gets December's file up as well as this current file from January right here, okay? Cheryl wants to know where she can actually find these prior presentations, Mark.
Okay, probably the best thing to do would be to demonstrate. If you go to the Manifest Investing website, and let me get some of my navigation stuff out of the way here, and you actually go up to Events. Click on Events, and then over here on the right-hand side, if you look for Recorded Events, click on that. And then what you literally will have is, we'll go back and look at one from a while back. this is from June of last year. You can see that that's the night Ken and I talked about fossil, but you can actually do the YouTube video there. So that's one place that you can find the presentations, again, under events. We try to post links to the archives right there. Then the other place is for any Manifest subscriber. If you go into the forum, you go into Portfolio Design and Management. And this is where we'll post the PowerPoint after the session. Actually look for the roundtable sessions. We'll go back and look at a September, for example. And again, we will post the link to the, sometimes you can actually get to a archived recording there, but you can see this particular month we posted a bunch of stuff, and included in here somewhere is probably the PowerPoint itself. Wow, I forgot we even did that. Here's the actual YouTube video down here and the PowerPoint itself. So you'll find that going back, again, either under events or in the forum. And again, even if you're not a Manifest subscriber, you can get to the events page. That is a public page.
I want everybody to understand that this is a free service provided by the volunteers of the Mid-Michigan chapter, with a lot of help from our friends Mark and Hugh and Cy and Ann and Kim and Herb and a few other folks. It's free, folks, and that means it's delicately maintained. That's a very easy way, or a very difficult way of saying, please don't put too much pressure on us if we don't meet your posting expectations. We're trying, but it's not our major job and our major focus. Mark, we have a question from Ruth, and Ruth, you're unmuted. Go ahead. Maybe Ruth just raised her hand inadvertently. I'm going to mute Ruth back up and put her hand down. Let's see if we have any other questions here. Does anybody, Mark, do you have any comments on either Apple or Coach?
Oh, wow. I guess I can talk a tiny bit about Apple, and you guys feel free to chime in. At the risk of when I told you so, if you go back and look at some of the stuff we were talking about, even in this forum a year ago, 15 months ago, we went back and actually talked about the history of Apple and how it had this propensity to have these sudden 50 to 60% drops in price. I'm not saying it's a bad company. I'm not saying anything like that. I'm just saying that is something that apparently is inherent to how it behaves. And we talked about using trailing stop limit orders for companies like Apple, almost putting it in a Roman candle category. And I've talked to a number of people that are just handstand crazy, cartwheel crazy, that thrilled that they did that with Apple, because they sold it, as much as $200 ago. Before this current price drop. So again, it's again, I don't want to brag, but I want to point out that we come together as a group and we point these things out, and you can learn from history and you can protect yourself in that type of a situation. And we just urge people to gain a greater understanding of trailing stop limit orders. When they apply, they don't apply to companies like Johnson & Johnson or Procter & Gamble usually. But they do apply to high-flying companies that have this propensity for large price drops. So again, I would urge you to make your own decision, understand trailing stop limit orders, make your own decision both individually and collectively as a club as to whether or not they make sense. We do not believe in across-the-board limit orders on portfolios. We think that's a recipe for disaster. But there are times when they make sense, and we just urge you to understand and explore them carefully.
Mark, I'll tell you something else that I've learned as an investor over the years, and that's when fashion and style seem to become an integral part of the stock analysis. That always bothers me, and especially when fashion and style seem to be what's leading the stock upward. I saw that with another stock that we talked about this evening. That was Chico's Fashions.
Exactly.
When suddenly the baby boomer businesswoman discovered a store that tailored was focused just on her, and it was as much a phenomena as it was a good, strong, fundamental investing picture. I think the same thing's true about Apple. Not only are we trying to study the finances behind Apple, but we're trying to gauge how fashionable and what kind of cachet exists with the article. It's the same problem I have when I look at a lot of teen retailers. I will confess it's the same thing that crossed my mind when I saw the presentation on, was it called Body Under? What was it tonight?
Body Central, thank you.
Body Central, okay. And it crossed my mind that we might be relying on pure fashion. And I've watched companies like Aeropostale and American Eagle and these types of companies come and go. So when I see companies that have this cachet involved with the fundamental analysis, that sets me thinking also, and tries to keep me out of some of those stocks on a regular basis.
Right, and again, I would urge everybody to understand, study the history of how that price behaves over time. You just mentioned some excellent ones, Ken. Urban Outfitters might be another one, but I did want to show on here, this is Expecting Alpha. If you go to expectingalpha.com, again, it's wide open and free. If you go down to this article here called Applesauce and Speed Bumps, I actually shared the stuff that Ken and I talked about a little over a year ago, and during sessions that we taught. And during that session, we talked about, at the time we were actually talking about whether the Apple of a year ago was suddenly behaving like the Qualcomm of the late 1990s. And in fact, there's the picture right there that we talked about, how back in 2001 and 2009 you had these massive price drops, and that's true going back even another 10 years for Apple. Just something to protect yourself from. But again, if you go to expectingalpha.com, you can access that article on Apple. Probably also find it if you do the search, which searches right at the Expecting Alpha site. There you go.
Well, we'd like to thank you all for coming this evening. We've pretty well gotten our question log cleared up. Our next roundtable, we've already set the date. It will be on February 26th. That's the fourth Tuesday in February, and that'll be our red carpet night. So you can expect not only to hear from Mark and myself and Hugh and Cy, but you'll also be hearing from Ann Manning and Kim Butcher, and we hope from our friends, some of our other friends, Herb Lemkool and Nick Strategos. We hope that they'll be with us, and we'll talk a little bit about our successes and some of our problems during the last year of existence, and we'll look into the future. So that's February 26th. If you want a reminder, drop me an email, and I'll add you to our reminder list. Mark, thanks as usual for being with us. Cy and Hugh, thank you so much for helping out again. It's greatly appreciated.
Welcome.
And Mid-Michigan folks, thanks for attending. As long as you attend, I think we'll be able to put a program on. Thanks a lot.
Thanks, guys.
Thanks, everyone.